Most limited company directors still use the same old formula. Bit of salary, bit of dividends, job done. But that can cost you more than you realize because your money can be taxed once inside the business and then again when you take it out personally. So in this video, I want to show you my WISE framework, which breaks down 31 legal ways to extract value from your limited company. As a business accountant, I help business owners with this all the time. We'll start with tax-free perks and low-effort strategies, then move on to more advanced methods. So let's begin with the easy wins most directors overlook. First in the WISE framework is W, which stands for work-related expenses. This is a great place to start because many directors think that tax planning starts with salary and dividends. Well, it doesn't. The first win is often much simpler than that. Sometimes it's just making sure the company pays for the costs that belong to the business instead of you paying them personally. So we'll split the first part of the framework into 4 different layers, starting with the easiest one first, the normal everyday costs. A good example is working from home. If you use part of your home for client work, admin, calls, bookkeeping, planning, or other company work, the company may be able to reimburse you. HMRC lets you claim a flat rate of £6 a week to cover things like electricity and heating without requiring receipts. This works out at £312 over the year. If it sounds tiny, it's because it is, but don't worry, because there is another method coming up later in the video that can help you more. Another everyday cost is your mobile phone. If the company provides the phone and the contract is in the company's name, the business can cover that cost directly. So instead of you paying for your iPhone and the phone bill personally each month, the company takes responsibility for it. And HMRC accepts that there can be some private use, so there is usually no separate benefit in kind issues to worry about. Then you have professional subscriptions and memberships. If you need them for the business, the company should usually be paying for them directly. That could be for things like accounting body fees, trade associations, industry memberships. It has to be something related to the business. If you're thinking about your golf club membership, that's unfortunately not going to work unless you're, I guess, Tiger Woods. From there, we naturally move into travel. If you use your own car for business journeys, the company can reimburse you using the approved mileage rates. That is 45p per mile for the first 10,000 miles and then 25p thereafter. So if you drive 4,000 business miles in the year, that is £1,800, the company can pay you tax efficiently. Just make sure you keep a mileage log. It's a bit of an admin, but most accounting software now has mileage tracking built in, so there's really no excuse not to do it properly. Another area people often miss is travel meals. It's also largely misunderstood area. Now, you can't say your lunch is a business expense just because you're eating at your work desk. But if you're traveling for genuine business reasons outside your normal pattern of work, the company can sometimes cover meals linked to that trip. This can be especially relevant for people like photographers, freelancers, surveyors, anyone who regularly works at different client sites. I'm not going to go deep into that here, but if your work involves a lot of travel, especially unpredictable travel, you should definitely look into it. Once those basics are in place, the next layer in the W part of the framework is the smaller tax-efficient perks. These are not huge on their own, but they still reduce the amount you have to spend from your own pocket. A classic example is trivial benefits. This is HMRC allowing small gifts as long as you stay within the rules. The main rule is that each benefit must cost less than £50 and it cannot be cash or something easily turned into cash. So a bottle of wine, a hamper or a spa voucher could work. A cash voucher wouldn't work. And you can usually do this up to 6 times a year, which gives you £300 in total to treat yourself or your loved ones. You also have the so-called annual staff functions. This means the company can pay for things like Christmas dinner, a summer event, a team event, anything that's open to all employees. The limit here is £150 per person per year. So if you do more than one annual event, you need to be careful here. Because if you go over that limit, even by as little as £1, the whole cost can become disallowable. If you're the only director in the company, you can still use this and your spouse can often join you too. Just keep the receipts and stay reasonable. So if you need an excuse to organize a summer barbecue now, now you have the perfect one. Then we get into a couple of more niche methods. If you spend most of your day in front of a screen, the company can usually cover your eye tests and certain prescription glasses needed for screen work. That's useful if you do a lot of admin, editing, bookkeeping, or design work. Similarly, if your work genuinely requires specific clothing, the company can cover that too. But in my experience, this is another often misunderstood area. We're not talking about the Nike shoes you bought because it makes you feel more stable and comfortable. Broadly speaking, if it can be used outside of work, it doesn't count. The things that do count is things like protective boots, high-vis jackets, personal protective equipment, branded uniforms. In other words, things you need because of the job, not because you want to look sharp in meetings. The next layer within the W part of the framework is where the company pays for things that improve your work or protect you. Strong example here is employer-funded training. If the training helps you get better at the work the business already does, it can usually be a sensible company expense. That might include things like software training, CPD courses, safety courses, technical skills development. So, for example, if you run a surveying business and the company pays for a course that improves your surveying work, that makes sense. But trying to use the company to fund a completely unrelated career change is a different story, and it doesn't fly with a taxman. Then there is director life insurance, often set up as a relevant life cover. This can be a good option because the premiums are often paid by the company, which can reduce corporation tax and usually do not count as a taxable benefit for you personally. But this one needs extra care because it depends on how the policy is set up and what it covers. So this is definitely one to review properly before doing anything. Once we get past the obvious stuff, the next layer is a bit more advanced. One example is selling personal assets to the company. If you personally own something the company genuinely needs, it could be something like a laptop, tools, camera gear, or office furniture, you may be able to transfer it into the company at a fair market value. That can be beneficial to you because it increases or improves your director's loan account and in some cases give the company capital allowances too. But it has to be sensible. This method should not be used as an excuse to sell your old sofa to the company because you once replied to an email while sitting on it. So if you're thinking about selling something to your company, it's best to check with your accountant. The final strategy from this section is entertaining business prospects. This is when the company pays for something like taking a potential client out for a meal. HMRC is very clear that this is usually not tax deductible for corporation tax, but I still wanted to include it here because even if it does not reduce corporation tax, it's still a real business cost the company can pay. In other words, it reduces the amount of money you need to withdraw personally to fund that same thing. So that is the W in the WISE framework. This is the safest and simplest place to start. And once that foundation is in place, we can move into the section that most directors care about. By the way, I'm putting all of these methods into a downloadable PDF and you'll find the link in the description of the video. Next, we move to the I of the WISE framework, which stands for income extraction. This section covers more direct ways to extract money from your company, and of course, we start with the classic salary and dividends combination. And there is a reason for that. Salary gives you a regular income, a national insurance record for your state pension, it helps you with things like mortgage applications, and it's a cost for the company. Then dividends can be used as a top-up because they attract lower tax rates and you don't pay national insurance tax on them. So a common starting point is a salary up to the 12,570 to utilize your personal allowance, then dividends on top up to about 50,000 where you're still in the basic rate band if you live in England and Wales. Once you go above that, you move into higher rate tax bands where dividend tax increases quite a bit. That's usually the point where you need to start looking into other strategies, like the ones in this video, to extract value from your company more efficiently. The important thing to remember about dividends is that they are distributed from after-tax profits. In other words, whatever profit is left after paying corporation tax is usually what's available as dividends. But before you rush into dividends, check whether the company already owes you money. If you've put some of your own money into the business, paid for business expenses personally, or built up a credit balance on your director's loan account, the company can repay that money back to you without creating an extra tax because you're simply getting your own money back. It's basically the same as lending someone money and later collecting it back. A really strong next step after this is employer pension contribution. This is where the company pays into your pension pot directly. Employer contributions into a registered pension scheme are tax deductible expense, so they can save you corporation tax. Let's say the company pays £10,000 into your pension. The full amount goes into your pension pot and your company saves £2,500 in corporation tax. The trade-off with pensions is obvious. You cannot use pension money to pay next month's rent, so this option is great if cash flow is comfortable and you're thinking long term. But if cash flow is tight and you have a sudden cash need, this is where a director's loan can be really useful. And if the loan stays below £10,000, you usually avoid the benefit in kind issues. But this is another area where people often get into trouble because they stop seeing it as a temporary loan and start treating it like free money. If you don't pay the money back within 9 months after your financial year end, the company can face a tax charge that is broadly designed to stop people using it as a cheap alternative to dividends. So yes, it is useful, but only if you treat it like a real loan. Now let me lighten the mood a little bit. The cycle to work scheme is one of those smaller wins that can still be worth to many people. If the company provides you with a bike and safety equipment, that can be a deductible business cost, and there is usually no benefit in kind charge if the scheme is set up properly. So if you want a bike for £600 plus helmet, lights and other gear, the company may be able to provide that instead of you buying it from taxed personal income. The main rule is that the bike should mainly be used for commuting or work-related travel at least 50% of the time. And this takes us nicely into salary sacrifice. This is where you agree to give up a part of your salary in exchange for a benefit instead. That can help reduce your personal income tax, your national insurance, and in some cases the employer's national insurance too. You can enter into salary sacrifice arrangements for things like pension contributions, electric vehicles, cycle to work scheme, some technology schemes. So let's say you sacrifice £300 a month into pension contributions. That is £3,600 a year that avoids being taken as salary, which can improve the overall position for both you and the company. But it must be set up properly through payroll. This is not something you decide informally over a cup of coffee in Greg's. Speaking of salary sacrifice, that leads naturally into company vehicles. This is one of the most talked about methods, especially when we're talking about electric vehicles and vans. Why? Because the tax treatment can be much better than people expect. Let's say the company buys an electric car for £25,000. The company often gets full tax relief for the vehicle and the running costs become responsibility of the company. You do need to pay a small benefit in kind tax charge, but in many cases there is still a net tax benefit if you do it right, and that's why it's definitely something you discuss with your accountant. And if you genuinely need an electric van, the tax treatment can be even better. At the moment, electric vans have a 0% benefit in kind rate, which means you can buy the van through the company, claim the available tax relief, use it personally, and not pay any tax on that personal use. So this is definitely something to look into before they remove that benefit as well. Now, here is one people often ignore because it sounds less exciting. And this is deferring income, because this is all about timing. Sometimes the best move is not changing what you take or how much you take, but changing when you take it. For example, imagine you're about to declare another £15,000 of dividends, but doing that now would push more of your income into a higher rate tax band. If you wait a little bit and take it in the next tax year instead, the total tax bill could be much lower. Of course, that will not always be possible because sometimes you need the cash now, but it's a useful reminder that tax planning is not only about what you take out, it's also about timing. And finally, there is employment allowance. This one is a bit different because it's not really a direct extraction method, it's more like a support tool. It can reduce the employer's national insurance bill by up to £10,500, which can make salary more attractive in the right circumstances. But if you're a one director company with no other employees, this usually will not apply. Where it becomes useful is when the company has other staff and qualifies properly. So in some cases, taking a higher salary can become more attractive. So that's the I in the WISE framework. This is the section most directors care about because this is where the money becomes personal. But the key lesson is that income extraction is not one method, it's a combination. And when you use the right combination, the results can be very different. And now we move to the S, which stands for smart structure. And this is where the conversation changes again, because up until now we have mainly talked about what the company can efficiently pay for and how you take money out. But now we're talking about the broader company setup itself. A good place to start is dividend splitting with a spouse. The idea here is simple. If your spouse owns shares in the company, they can receive dividends too. That means you may be able to use their tax bonds instead of forcing all the dividends income into your own. For example, if the company pays £20,000 of dividends and all of it goes to one spouse who is already in a higher tax band, more of it could be taxed at up to 39.35%. But if some of that dividend goes to a spouse with spare basic rate band, part of it might only be taxed at 10.75%. And that leads us naturally into alphabet shares. This is where you create different classes of shares, like A shares and B shares, so you have more flexibility over who gets what. This can be useful if you need more control over what ownership rights they carry and when their holder is entitled to receive a dividend. And yes, you can issue shares to other family members too. And once you start thinking about at household level, another obvious question becomes, what if family members are already helping in the business? That is where employing family members comes in as a different method. This can work very well, but only if it's genuine. The family member needs to do real work, be paid a commercial amount, and go through payroll like everybody else. For example, if your spouse helps with admin, social media, chasing invoices, bookkeeping support for 8 hours a week, paying them a sensible wage can move income into their tax position instead of leaving all the profit to be taxed through yours. The same strategy can also work with older children and teenagers if the work is real. Now let's move from people to property. Earlier in this video, I mentioned the simple £6 per week home working allowance. But if your company uses a bigger part of your home and that flat rate feels too small, another option is renting part of your home to your company. This is more formal because the company pays you rent, but now you also create rental income personally. So this is not automatically better because it depends on the numbers. For example, if the company pays you £300 a month for rent, that is £3,600 a year coming to you personally. That sounds good, but then you need to compare the personal tax on that rent, the paperwork needed, and whether a simpler claim would have been better. This is definitely not a beginner move, so you should review it with your accountant. The next one is a bit more niche, but it's still worth knowing about. This is using your capital gains tax allowance. HMRC gives you a 3,000 annual exempt amount, which means you can make gains up to that level before your capital gains tax kicks in. This is most useful where you're dealing with shares. For example, selling shares to an investor, to a family member, or where the company is buying back some of its own shares. So let's say you sell shares for £10,000 and their original cost was £1,000. That gives you a gain of £9,000. If you can use the £3,000 exemption, you only pay tax on £6,000. This method shows that sometimes the question is not about income tax at all. It can be for something completely different like capital gains tax. And that brings us to the final method of the smart structure part, and this is where business relief for inheritance tax comes in. If you're building a successful trading company and want to pass it on one day, this can be extremely important because without it, a family business could end up being sold just to pay a tax bill. Imagine Sarah owns 100% of a trading company worth £1 million. If business relief did not apply, that value could be exposed to inheritance tax at 40%. But if the business qualifies, she may get 100% relief, which can make a huge difference to the family's long-term wealth. So this is the S in the WISE framework. This section is less about pulling money out directly, it is more about setting the company up in a smarter way. You can think of it as the architecture of the whole plan. And once that architecture is in place, we can move to the final stage. And now we get to the final letter E, which stands for exit. This is where the conversation changes one last time, because up until now we have mostly been talking about taking value out while the company is still running. But eventually some directors want to sell the business, hand it over, or shut it down. And when that happens, the question becomes how to extract the remaining value in the cleanest way possible before we wind up the company. A good example is members voluntary liquidation, or MVL. This works best when the company is solvent, has no serious debts, and the owners want to close it properly. And this works very well alongside business asset disposal relief or BADR. So these two are separate, but they work well together. Here is a simple example. Imagine your company has 150,000 of accumulated profits over the years, also known as retained earnings. You want to shut the company down and extract that money in the most efficient way possible. Option 1, take it all as dividends. That's the easy choice, but a big part of that money will be taxed in the higher dividend tax rates, potentially up to 39.35%. Option 2, close the company through an MVL. That can turn the final distribution into capital instead of income. In other words, HMRC will treat the 150,000 as a capital extraction rather than an income extraction, so it will be taxed at the lower capital gains tax rates of 18 or 24%, depending on your income tax band. And if BADR applies, the entire gain may be taxed at only 18% instead. That is a very big difference, especially as numbers go up. But this is also one of those areas where you need to be careful. HMRC doesn't like people closing one company just to save tax and then starting the same trade again through a different company. So if you're at this stage, get a proper advice. Another exit route is an employee ownership trust or EOT. This is very different from an MVL. Instead of closing the company, you sell a controlling interest into a trust for the benefit of the employees. This is often used when the owner wants to step back, but the business keeps going. So unlike an MVL, this is not about winding up the company. It's more about succession. People sometimes use this when they want to stay involved as a managing director or CEO, but no longer want direct ownership. In the past, EOTs were even more attractive from a tax perspective because there was no tax to pay on the sale of the controlling shareholding. But since November 2025, only 50% of the gain is exempt and the other half is taxed under the normal capital gains tax rules. So it can still be useful, just not as much as it once was, which has been the trend with many tax rules in recent years. So this is the E in the WISE framework. That is the final layer because it's all about the end game. It's about making sure that when you sell, hand over or close the company, you do not lose a huge amount of the value right at the finish line. So now you know 31 different ways to extract value from your company. And you can find the link to the PDF in the description, so it's easy to save and come back to it later. But knowing the methods, it's only the first step. The real question is which ones actually fit your situation. So watch this video next, where I break down 4 main types of limited company directors and help you work out which strategies are most relevant for you.